Silver is trading at $75.56 right now. Friday, April 25th, 2026, 8:36 a.m. New York time, up 25 cents on the session. Days range, 73.84 to 76.77. Now, most silver analysts are going to tell you this is just another day, just another small move in a volatile market. They'll give you the same analysis they gave you yesterday, and the day before that, and the week before that. But here's what they're not telling you. We are sitting at the beginning of the most critical 30-day period silver has faced in 2026. Not because I say so, because the chart says so. Silver is trading inside a compression pattern that has been building for 6 weeks. Every day that passes, this pattern gets tighter. The volatility is contracting. The decision is approaching. And within the next 30 days, likely sooner, silver is going to break one of two ways. Either it breaks above $78 and confirms the next leg of this bull market, potentially targeting $90 to $100 by summer. Or it fails here, breaks below 72, and we enter a correction that could take us back to the mid-60s before the structural bid reasserts itself. Two completely different scenarios, two completely different positioning strategies. And right now, we're in the decision zone. I'm your name. This is the Stack Guy. And today, I'm going to give you something nobody else is giving you. A clear, specific roadmap for the next 30 days. I'm going to show you the exact technical levels that matter. What happens if we break above resistance? What happens if we break below support? The specific catalysts that could force the decision. What you should be doing right now based on your position. No repetition, no ambiguity. No, it could go either way, so just hold forever. By the end of this video, you'll know exactly what to watch, exactly what it means, and exactly how to position. Silver has been trading in a symmetrical triangle pattern since March 10th. That's 6 weeks of compression. The upper boundary of this triangle started at $79. It's now at $78.20. The lower boundary started at $70. It's now at $73.50. Every day, these boundaries move closer together. The pattern is converging, and convergence means decision. Primary resistance, 78 to 78.50. This is the upper triangle boundary plus the previous session high we saw on April 23rd. Primary support, 72.50 to 73. This is the lower triangle boundary plus a previous consolidation zone from late March. Current price, 75.56. We are sitting almost exactly in the middle of this range. Volume has been declining throughout this 6-week pattern. That's normal for a triangle. It's called compression. Volume surges. Price moves violently in the direction of the break, and the move is usually proportional to the width of the pattern. This triangle is about $6 wide. If we break to the upside, technical measurement gives us a minimum target of $6 added to the breakout point. 78 plus 6 equals $84 as the first technical target. If we break to the downside, same measurement applies. 73 minus 6 equals $67 as the downside target. Technical patterns don't exist in a vacuum. Let me show you what gold is doing, because this adds crucial context. Gold is currently at 46.92. Gold has already broken out of its triangle pattern. It happened 2 weeks ago when gold cleared 4,500. Historically, when gold breaks first and silver is still consolidating, silver follows within 2 to 4 weeks. We're now in week 3 since gold's breakout. The gold-silver ratio right now is 62.0. That's 46.92 divided by 75.56. In 2024, the ratio compressed from 65 to 48 in 8 weeks when this exact pattern played out. In 2020, it compressed from 125 to 70 in 12 weeks. We're at 62 now. If we compress to 50, which is still historically wide, silver would need to be at $93 with gold at current levels. Gold at 4,192s, $50 and $93.84 silver. That's the mathematical setup. But math doesn't move markets. Catalysts do. When I say the next 30 days could decide the trend, I'm not being dramatic. I'm being specific. Because within this 30-day window, we have 4 major catalysts that have the potential to break this pattern. Catalyst number 1, COMEX, May contract expiration, April 30th. The May futures contracts expire on April 30th. That's 5 days from now. Right now, there are still significant open positions in May contracts. These positions need to either roll to July or stand for delivery. COMEX registered silver, that's the silver actually available for delivery, is currently at its lowest level since 2022. We're looking at approximately 42 million ounces registered. That sounds like a lot until you realize that represents less than 2 weeks of global industrial consumption. If May delivery demands exceed 15 million ounces, you're going to see immediate pressure on registered stocks. Watch the COMEX warehouse reports daily next week. If registered silver starts dropping sharply, that's your first signal that physical demand is overwhelming the paper market's ability to suppress price. Catalyst number 2, U.S. jobs report, May the 2nd. If the jobs report comes in weak, it increases the probability of Federal Reserve rate cuts. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver. If the jobs report comes in strong, it pushes rate cut expectations further out, strengthens the dollar, and creates near-term headwinds for silver. Weak jobs report a bullish catalyst for silver. Strong jobs report some bearish near-term pressure. Catalyst number 3, Chinese economic data, May 8th to May 12th. China is the world's largest industrial silver consumer. If industrial production accelerates, silver demand accelerates with it. Specifically, watch for solar panel production data. China manufactures over 70% of global solar panels. Every solar panel requires approximately 20 grams of silver. In 2024 and 2025, strong Chinese industrial data preceded silver rallies by 10 to 14 days. Catalyst number 4, FOMC meeting minutes, May 21st. The market is currently pricing in a 38% probability of a rate cut by July. If the FOMC minutes reveal more dovish sentiment than expected, that probability jumps and precious metals rally. If the minutes are hawkish, inflation concerns, strong economy rhetoric, rate cut expectations get pushed back, dollar strengthens, and metals face pressure. April 30th, COMEX contract expiration. May 2, jobs report. May 8-12, China data. May 21, FOMC minutes. 4 catalysts, 30 days. Any one of them could be the trigger that breaks this triangle pattern. Let's start with the bull case, because this is the scenario most silver holders are positioned for, and it's the one that the structural fundamentals support. The bull scenario, breakout. Above $78, silver needs to close a daily candle above $78 with strong volume. Not just touch 78 intraday and reverse, not spike to 78.20 and pull back. A daily close above 78, preferably 78.50 to avoid the false breakout zone. Volume on the breakout day needs to be at least 50% above the 20-day average. First target, $84. This is the measured move from the triangle. 78 plus 6 equals 84. At 84, you'll see profit taking. Early buyers will lighten positions. That's normal. If we consolidate at 84 for a few days and then push higher, that's extremely bullish. Second target, $92.90. This is the 2026 high from February. It's also a psychologically significant level and a previous resistance zone. If we reach 92 to 95, we're no longer in a consolidation. We're in a confirmed uptrend. Third target, $108 and $112. This comes from 2 sources: Fibonacci extension from the triangle base and the gold-silver ratio compressing to 55, while gold holds current levels. At 108 to 112, silver has officially entered a parabolic phase. If the breakout happens in the next week, triggered by COMEX deliveries or the jobs report, the move to 84 could happen in 7 to 10 days. If the breakout happens mid-May, triggered by China data, the move could be slower, 15 to 20 days to reach 84. If we don't break out until late May after the FOMC minutes, we're looking at a June rally into summer. The Silver Institute's latest data shows a structural deficit of 215 million ounces for 2025. Early 2026 data suggests the deficit is widening, not narrowing. Solar panel production is accelerating globally. The International Energy Agency's April update shows solar installations are tracking 30% above their initial forecast. More solar panels equals more silver consumption. This isn't speculative. This is contracted demand that's already in production schedules. Every ounce that stands for delivery comes out of registered stocks. If registered silver drops below 30 million ounces, you create a crisis of confidence in the paper market's ability to deliver physical metal. When that confidence breaks, you don't get a gradual repricing, you get a squeeze. Look at what happened in palladium in 2020. Look at nickel in 2022. When physical markets get tight and paper markets are over-leveraged, the repricing is violent. If gold stays at 4,700 and the ratio compresses to just 55, which is still above the historical bull market average, silver mathematically needs to be at $85. If gold pushes to 5,000, which multiple banks are now forecasting, and the ratio compresses to 50, silver needs to be at $100. I'm not here to pump your bags. I'm here to give you reality. And the reality is that there's a scenario where silver breaks down from here, and if you're not prepared for it, it will hurt. The bear scenario, breakdown below $72. Silver closes a daily candle below 72.50 with expanding volume. This breaks the lower boundary of the triangle and violates the support zone from late March. First target, 67.7 and 68. This is the measured move from the triangle. 73 minus 6 equals 67, but there's support at 67 to 68 from previous consolidation in February. At 67 to 68, you'll see value buyers step in. Long-term physical buyers, deep value funds, they'll try to stabilize it. If that support holds, we get a base building period. Could be weeks, could be months. Second target, 62.63 hours. This is the 200-day moving average and the major support zone from January. Third target, 58.60. This is worst case scenario. Full correction back to the Q4 2025 breakout zone. If equity markets sell off hard, S&P drops 10% or more, you get an initial spike in precious metals as fear rises, but then you get forced liquidation. Miners will get destroyed in a breakdown scenario. They don't just track silver down, they amplify it. A breakdown to 67 to 68 is the gift you've been waiting for. Back up the truck on physical silver. Indicator, under 1, daily close. Relative to $75. $75 is the midpoint of our range. It's also psychological support. If we close above 75 for 5 consecutive days, the bias is shifting bullish. If we close below 75 for 3 consecutive days, the bias is shifting bearish. Indicator number 2, COMEX registered silver. Check the COMEX warehouse stocks report every day. It's published by the CME at around 3:30 p.m. Eastern. If registered silver drops below 40 million ounces, stress building. If it drops below 35 million ounces, acute stress. If it drops below 30 million ounces, crisis mode. The gold-silver ratio doesn't lie. It's pure math. And historically, rapid ratio compression has preceded explosive silver moves. The next 30 days are going to be interesting. Stay disciplined, stay informed, and stay ready. I'm the Stack Guy. See you in the next one.